Hello, Theo traders. This is Gianni DePoce, and today is the 2nd of April, 2024. It's been a really interesting and exciting start to the second quarter here. We're starting to see some selling across the board in many different stocks. Indices are on the retreat here today, and in fact, they started off the quarter this way as well. We're generally seeing technology lead the sell-off lower with a couple of exceptions here and there, but some notable pockets of strength that I want to cover in deeper depth today. So we'll look at that in just a moment, but take a look at the S&P 500. It's been rallying within this ascending price channel here. And as a rule, I like to own markets or stocks or whatever the security may be that are rising within channels, but I don't like to really buy all that much within the channel. Now, if we do break below this lower trend line here in the S&P, it does not mean that the bull trend is nullified. All it means is that the market slope or the rate of ascent is no longer in effect. So it's really important to differentiate between the two, because if we start to see, volatility spike even more in the coming days, you better believe there's going to be an uptick in hysterical commentary. And just rest assured that this market remains very much in a bull trend, and any forthcoming selling would likely be totally cyclical, totally healthy, and totally normal. So there's quite a bit of support in the S&P in the 5,000, let's call it $4,900, $5,100 area. I'm looking for some support in that zone to begin with, and then we'll see how we react. But, in terms of, where the selling is happening, you can see the NASDAQ leading the market lower today. You're also seeing semiconductors lead the sell-off lower, and that is a risk-off signal, right? Semiconductors tend to act as a leading indicator within the overall market, and I think what's happening right now is the market totally mispriced the risk of rising inflation. And keep in mind, coming into this year, markets were looking for the Fed to cut rates upwards of 7 times. Now we're looking at 3, and given the recent price action we've seen in energy and in bonds, I don't even know if we'll get that. But it's not all bad news. Let's go ahead and jump over to the bond market and just talk about this with the chart on the screen. What's happening now, despite the yield curve still being inverted, is you're seeing longer term bonds sell off more. So you're seeing, the 30-year bond as of this video down almost a full point, or 0.7%, while the 10-year note is down about 0.2%. So you're seeing long-term rates rise faster than shorter-term rates, and that's normal because the longer end of the curve is more sensitive to fluctuations in inflation expectations, and the shorter end of the curve, which is dictated more by Fed policy, not so much the 10-year note, but just generally speaking, that principle holds true. But what this is doing, let's go ahead and jump over to the actual 30-year interest rate here. We're at about 4.5% on the 30-year bond. If we rally back to 5% or even exceed this high from October of 2023, you're going to have a situation, assuming the Fed doesn't budge in the meantime, where you're still inverted, but the spread between, the 90-day Treasury bill and the 30-year bond is only 50 basis points. So that creates a scenario where the Fed does not have to cut as much to re-steepen the yield curve. Because remember, coming out of an economic contraction, which we're not in now, but it's a possibility down the line, and inflation may be the catalyst, because only inflation could really change consumer spending patterns, and consumption is the backbone of the U.S. economy. But in a situation where the Fed does not have to cut as much, that's a good thing. So if we are able to weather a minor recession, because that's all I think it would be, is minor, several months from now, with the Fed only cutting rates to say 4% or 3.5%, when it's all said and done, you get a massive re-steepening of the yield curve after that. That gives the Fed even more firepower in the future to combat a true economic contraction. And that's a good thing. Okay, we don't want to be stuck at the zero bound like the Bank of Japan is. And in fact, I would argue, keep a close eye on what's happening with the Japanese yen over the next couple of weeks, because we're back at the level here in the Japanese yen where the Bank of Japan had to step in last year and intervene to maintain its value. And now we're having interest rates go up again here in the US. That's why bonds are selling off. So this is a really dangerous position in bond markets and currency markets. I know most people pay attention to the stock market, but just recognize that this is all connected. And so what does this mean for your equity portfolio and the stock market in general? Well, generally, when bonds sell off and interest rates rise, you'll have inflation-related sectors do better. So you're seeing energy do well today. It's catching a bid. In fact, the only other sector that's up right now is utilities. But keep a close eye on industrials and basic materials that have acted generally strong in the last couple of weeks. And I especially like what's happening in consumer staples. Despite today's sell-off, there's some really bright pockets of strength. But take a look at a longer-term chart here. Consumer staples, we'll even look at the monthly chart here. It's close to its all-time highs. Compare that to consumer discretionary, which is, again, consumption is the backbone of the American economy, and discretionary spending really is where margins are made or won or lost. So this is a really dangerous sign, I think, that we're seeing in the overall market. And I've made the point to members to, hey, we need to start positioning ourselves more in defensive segments of the markets. Energy, some of our energy trades are flat on the day, but PBF made a new all-time high today. Still long Viper Energy that's consolidating near its highs. And of course, Matador Resources did get a gap down last week, but I still like the chart overall. We did trigger a long position in SM Energy Company yesterday as well, so that's looking good. And I know many of you have been long Technip, FMC, FTI ticker symbol, and that's approaching its upside target. So energy has been doing pretty well, and that's pretty typical to see in a rising rate environment. But what really impresses me right now, again, because bonds are selling off, rates are rising, is the strength in precious metals. Gold hitting another new all-time high today. And the dollar is selling off a little bit. So, but even so, this move that we've seen higher in metals over the last couple of weeks has been generally off the back of a rallying dollar too. And that's very impressive. But check out what's going on in silver today. Up almost 3.5%. And we're pressing up against this multi-year resistance zone. Guys, if silver breaks above 2650, I don't think it's even going to hold much longer at 28. I think this thing's going to be going to $35 an ounce pretty quickly. And, some of the metal trades that we've had on the books, Agnico Eagle Mines and Anglo Ashanti have been doing pretty well. We also had long positions triggering El Dorado Gold, which is seeing a nice bid, and in Osisko Gold Royalties. That one's acting a little bit slow. But overall, I really like the price action that's happening in the precious metal space. GDX pressing up against multi-month resistance. Even the silver mining ETF, which has been beaten down and really in the doldrums for quite some time, is showing signs of life. So do not sleep on what's happening in precious metals here, because I don't want to say we're super early, but I still think we're early enough to where opportunities are present. Last but certainly not least, I'm going to talk about Bitcoin and crypto. I think a secondary lower high is complete. I'd like to see some selling accelerate into month end, but keep some cash at hand, some dry gunpowder ready, because I think there's going to be a tremendous dip buying opportunity in crypto. I think the sell-off is temporary. Just like I see the overall market right now, I think we have to be ready to buy dips in the coming weeks. And if we see a spike in bearish sentiment, I'm going to welcome that with open arms because of how bullish everything has been for so long. So that takes care of everything that I wanted to share with you today, everyone. Really appreciate you watching this video, and I hope to see you in the TheoTRADE chat room. Thanks again.